Hello, and welcome to Idea to IPO. I'm Jason Putnam Gordon, an emerging growth and venture capital attorney with K&L Gates, LLP. Today's presentation is how to raise seed funding for your startup, convertible notes and safes. A couple notes before we get started. I'm running all the tech in the background, so I appreciate your patience if there are any technical glitches. Today's presentation is recorded. Great news is, if you missed some or all of it, I'm going to follow up with you and send you a copy of the recording after today's presentation. Give me a couple days to get it together. Downside is we want to make sure that you're not going to share any confidential information on today's call or in the chat. So please don't share that because it will be recorded and memorialized for posterity and made available afterwards. Please fill out the audience survey, and you do that while we kind of proceed with today's discussion. Now, an important place to begin here is that today's conversation is about providing you with general information on venture capital, seed financings. It's not legal advice. We're going to be talking about rules and exceptions to those exceptions. So it may or may not apply to your particular situation. Always retain competent legal counsel in connection with any transaction or decision that you're going to make in terms of financing or your other legal needs. The corollary to that is that today's answers to your questions are not and should not be taken as legal advice. Additionally, if we follow up and have a friendly conversation afterwards, the same thing is true, unless until you sign a written engagement agreement and we've cleared conflicts. Now, let's keep rolling. So, provide you with a little bit of a roadmap as to today's conversation. We're going to go over my background. Then we're going to go over structural considerations of seed financings. Then we're going to talk about some considerations you should keep in mind when you're pitching investors. We'll follow up with discussing the financing options. And we'll continue on key terms and considerations when you're using convertible securities. We'll talk about the ever important issue of valuation and dilution, and then we'll wrap it up with some common pitfalls and some Q&A. So I think I'll probably speak for about an hour or so. If you've got questions, terrific. Please submit them via the Q&A function, not the chat function. I'm by and large not going to be monitoring the. I will not be monitoring the chat feature today. So use the Q&A. What I'm going to try and do is proceed with today's discussion and then maybe pause to take some questions on a sort of topic by topic basis. All right, let me tell you a little bit about myself. I'm a venture capital and emerging growth company attorney. I've been practicing law since 2005. My office is in San Francisco, California, but I work with clients and companies throughout the US and the rest of the world. One of the wonderful things about being in the Bay Area is that there's a lot of tech, there's a lot of venture, and if you're playing in that space, many times you will have some sort of connection with the Bay Area. And so that's typically where I'll get involved. I love working with entrepreneurs on financings as outside counsel and when they have exits. K&L Gates is a fully integrated, full-service law firm with over 40 offices on 5 different continents and close to 2,000 attorneys, with a deep history in working with venture and venture-backed companies. I have to also mention that I am an entrepreneur myself. Before returning to a big law firm, I actually ran my own little boutique for a number of years. And so many of my experiences in terms of starting a business basically from scratch resonate with many of my clients. And I think it makes me, and they've told me, it makes me a better advisor for them. All right. Let's take a look and talk about, see who's in the room. So we've got a really strong contingent from the Bay Area with almost 30%, and then 40% from the US. We've got a quarter of the people basically from Europe, and then a few other, about 10% from elsewhere in the North America. Now, of course, today's conversation is recorded, so there may be viewers who are time shifted, and we appreciate you attending. Thank you for attending. I also want to say just a quick thank you. I know that I've had to reschedule this twice. I'm actually out on a parental leave right now. And we've had some health issues that have been going on. Everything seems to be under control now, but I do appreciate your patience. And this is the first time in, I think, 10 years of doing these that I've had to reschedule any of them. So it was bound to happen at some point. All right, well, let's talk about some structural considerations for these deals. So let's start by just talking about some background information, which is the startup financing lifecycle. I find that's always really very helpful for entrepreneurs to understand the startup financing lifecycle, because raising venture capital is not the right model for every business. In fact, the vast majority of businesses, it's not the right model whatsoever. That model involves basically raising successive rounds of capital so that you can sufficiently grow the company and take advantage of either a new market opportunity, an emerging market, or some new technology that you're commercializing. It involves, these are companies that will need to raise tens, if not hundreds of millions of dollars in order to scale. And they should be able to achieve sort of the growth and an exit within 7 years, let's say, of raising venture capital. Now, not all businesses are like that. And even within the venture space, there's going to be a difference between SaaS companies, let's say, and life science companies. But that's sort of, by and large, the framework. And you can see, I've got a little graphic here of what the financing life cycle is. So you start out, you raise your first money from angels, friends, and family. That's your seed capital, okay? And that's basically what we're focused on today. Those initial raises, seed funding via SAFE or convertible note. Then, unless you're in a space like, let's just say, life sciences or something like that, if you're in like a CPG, consumer packaged goods space, you're in a SaaS space, kind of once you start getting some traction, that's when you would actually go out and raise your venture capital. And typically a first round's either called a Series Seed or it's called a Series A. And that would be your first round. And you would then take that money and scale sort of up to the next inflection point, and you would then raise additional money to scale up to the next inflection point, et cetera, until having an exit, which the sort of target for most venture-backed companies is in an IPO, an initial public offering. But the vast majority of successful exits are actually done via M&A, merger and acquisition. And not to sort of bury the lead on things, I think, especially here in the US, if we're talking about a venture-backed company, we're going to typically see them started as a Delaware C Corp. The framework that we look at and think about for this is the same matrix that we'd sort of apply to any business. We take a look at, and in no particular order, and I say no particular order because, each of these criteria is going to be, what's more important for one business versus another is going to be, specific to that business. So we take a look at taxes. We take a look at liability issues and shielding from liability. That is, shielding the personal assets of the owners. We talk about ownership structure and equity grants, basically who's going to need to be on that capitalization table. We talk about, and this is something that really drives a lot of the, decision to be a Delaware C Corp, capital raising requirements and what your investors are going to insist upon. We talk about management requirements. That is, are your investors going to need to have a seat at the management table? We think about your exits ahead of time, right? We were just talking about how an exit's typically sort of 7 years from when you raise venture capital. And we think about the regulatory framework in which the business resides. Now, sometimes even in the venture space, that's going to push you out of a C Corp, but it's important to take a look at that. Now, many times we get a question, especially here in the US, like, why Delaware? Well, Delaware is home to the vast majority of corporations, and certainly large corporations here in the US. That's because of a few things. They have very developed corporate law, which involves, generally speaking, more liability protection for directors and officers. That's important for your investors, as they're probably going to have a director on the table. Delaware also has the sophisticated Court of Chancery, which hears, among other things, business disputes. And then another, sort of odd selling point is the Delaware Secretary of State's office is really wonderful in terms of being able to quickly and efficiently file corporate documents. And, if I were not initiated, I would not understand why that is so important. But being on the inside and having worked in this space for many years, I can tell you how critical it is to be able to get documents filed so you can get transactions done, which would involve financings or exits, et cetera. Now, frequently we also get a question in terms of like, why a C Corp? Well, that's because of the investors that you would contemplate having if you were, going to go down the venture capital route. And that's because the venture firms are set up as pass-through entities, meaning that the profits and losses of that entity is getting passed through to their investors, their limited partners. And as a result, they need to be investing basically into blocker entities that will retain the profits and losses in themselves. And that's what a C Corp does. And so that's what pushes it to be a C Corp. One question that I frequently get, sort of typically around this stage, is like, what about LLCs? What if I've got an LLC? Well, like the answer is like, don't panic. We might not have set you, I don't know, we would run the matrix, right? And we would figure out whether or not that was the right entity at the outset. But if you haven't done that, you've already set yourself up with something, don't panic. It's something we can take a look at and potentially pivot away from. It would just depend, does it make sense to do it now? Does it make sense to do it later? Do you think you can make it happen? Do you have all the requisite votes that you need to be able to make it happen? We've got a question about whether or not this is recorded. The answer is yes, this is recorded, and I will follow up via email later, in a few days to a week or so, and get you the recording. That's the plan. All right. If you have any questions, please feel free to use the Q&A rather than the chat. I'm going to keep going unless there are any other questions about this. Question about how a C Corp is different than an LLC. Well, a C Corp is an entity in and of itself. It's got, the ownership structure is such that the owners are stockholders, so they own stock in a company. The entity is then managed by the board of directors, and then it's got executives who carry out sort of the will of the management, the decisions of the management. An LLC is actually much more like a partnership, although it's got a limited liability aspect. So that respect, the limited liability part is like a corporation. But, in a sort of more traditional partnership, or in this case, an LLC, you've got partners, or in the case of an LLC, you've got members who are the owners. And traditionally, the members of the partners are involved in the decision-making and management process, all of them. Now, one of the cool things about LLCs is you can kind of slice and dice and re-engineer all of it to really make an LLC function and act as a partnership, as a more like a corporation, but kind of functionally, they kind of come from different worlds, where a corporation is owned by stockholders, managed by the board, with the executives, running the day-to-day, carrying out the decisions of the board, versus an LLC traditionally is owned by the members, managed by the members, and frequently the members are the ones who are sort of running the day-to-day, on behalf of the rest of the membership. All right. So let's talk a little bit about pitching investors, because I think it's important. If we're talking about basically how to raise seed funding, safes, and convertible notes, you need to know your audience. Okay, so different investors have different objectives, and I want to, because we're talking about companies that are intended to be venture-backed, and again, that's not the right fit for everybody, but since we're talking about companies that are intended to be venture-backed, kind of let's talk about who we would expect to be the end investor, right? That would be a traditional venture capital fund. And as I mentioned before, those funds actually have investors, right? The investors in a venture capital fund are their limited partners, their LPs. And those folks are typically promised a return on the capital that they put in for 10 years, 10, 12 years, something along those lines. And, the sort of, if you kind of spend some time hunting around, you sort of see maybe the figure of 3x over the life of the fund. And the way, one sort of typically hears or understands about, how venture capitalists think about earning that return for their investors is that they will make a lot of bets. It depends on what, the way it's set up, but maybe 25, maybe 50 bets, right? And by bets, I really mean investments or companies in which they will invest. They'll have that many portfolio companies. And the understanding is sort of high risk, high reward. There will be many companies that, go under or only have a very limited return, but there will be a few very large winners, and that will return the lion's share of what is needed for the fund to be able to meet its expectations for its investors. And what we've sort of seen and heard, and what seems to be out there in the literature is, what is a winner? Well, a winner is, 18 to 24 months, sort of doubling or maybe even tripling in value over that period of time. So you could see how an early stage investor with $1 million investment, if in a sort of a winner company, in 24 months, it's then $2 million. It's that value of that is worth $2 million. In 24 months, it's then worth $4 million. And then it's $8 million. And then maybe it's $16 million. And so, they could be 16x or 32x or greater over the course of the investment. Now, that is sort of the traditional venture capital fund. There are also a lot of players in the venture space, including strategic investors, and they've got a different set of goals, right? So the traditional fund is make it financial, make an investment, get a return for the fund and your investors. Strategics have different incentives. Some strategics are focused on developing a market for their products, right? They make widgets, and so they want to nurture companies that are going to use their widgets, right? Others are interested in other things like being able to acquire talent or get additional technology, or maybe it's to maintain their market position and relevance. Angels, which play quite frequently in the space of convertible notes and safes and that sort of initial seed financing, they are as unique as the individuals that make up what an angel is, right? So an angel is usually an investor that's got a sufficiently large checkbook and is hopefully an accredited investor, which we can probably talk about a little bit later, who will cut a sufficiently large check. And many times they are entrepreneurs who have had a successful exit, and they're looking to sort of reseed, that is, put funds back into sort of the ecosystem that they were a big winner in. Other times, some people are just interested in a particular kind of technology. I mean, we will see quite a lot of interest, for example, in climate and the energy space, things that people can really get behind. And so, and then other times, right, within the angel sort of space, you'll have bands of angels, which will be groups of angels that basically sort of work together to share resources and then make investments. Super angels are really just angels that have a really big wallet and will be cutting big checks. And so, knowing your audience, I think, is really very important. What you're going to want to do is you're going to want to meet with and develop relationships, a substantial relationship with investor prior to, asking for a check. I think that's the optimal for compliance for securities laws. And then the other thing too is, so much, especially at the early stage, is sort of relationship driven that, to move through that trust barrier, it's good to kind of get the relationship going before there's time for an ask. Okay. Someone wants to understand what the definition of securities laws are. So securities laws are laws that involve the sales of securities in a jurisdiction. So securities are safes, convertible notes, stock. They're basically the investments in the company. Most of the investments in the company. It's an easy way to sort of think about it. It can also be investment contracts, but we don't need to go there. Certainly, we're talking about safes and convertible notes, and for those purposes, we're talking about the sale of securities. And at least here in the United States, securities laws are primarily focused on basically consumer protection, making sure that either the consumer or the purchaser is substantially sophisticated enough to protect himself, herself, itself in the case of an entity, or themselves, depending upon which pronouns and which group we're talking about here. So, yes. Now, in the US, it's regulated both at the federal level, which is by the SEC. I see someone's writing into me about that, but also at each individual state level. So each individual state has its own securities laws that you need to think about and pay attention to. Just trying to think if we have another slide on this later I was going to talk about, but I don't think we do. So I think I can go into it now. Many times I sort of get the question or the comment like, well, we're just a tiny company. How is it that the securities laws apply to us? And the answer is like, they do. And, if you don't target an exemption from them, and that's what we typically do, especially for early stage companies, is we take a look at the securities laws and say, okay, all right, well, actually, so long as you are selling to accredited investors, and you've got a pre-existing substantial relationship with them, and, you do this and that, you've got an exemption. And so that's how we achieve compliance with them, as opposed to having to register with the SEC, which is very expensive and time consuming. We've got a question about how investors value a startup. I'm going to hold that question until a little bit later, but I do want to maybe preview the answer, which is early stage startups. It's probably a little bit more art than science. Some helpful indications are really sort of comparables, if there are any other comparable companies out there. But to a certain extent, especially if you're talking about a company that's just getting going, maybe has revenue, maybe doesn't have revenue, it's oftentimes kind of more about what will the market bear? What are you willing to sell the company, that sort of chunk of the company for? And how much money do you need to raise? Financing options. So we are getting towards kind of what today's conversation is truly about on the nuts and bolts level, which is using safes and convertible notes to raise seed funding. Now, if you think back to the diagram that I put up earlier, that initial stage when you're putting together your initial team, your initial product to get to market, we're talking about raises in the aggregate of up to 3 million, 5 million, maybe even 10 million up here, done by, safes or convertible notes. Convertible notes are also known as bridge notes. I like to sort of view them as being sort of like the parent of convertible equity, which is also known as a SAFE, a simple agreement for future equity, which is, safes were developed by Y Combinator. And we're going to get into the terms of convertible notes and safes in a minute. That's in contrast to like actual preferred stock financing, also known sort of as a true venture round, where you'd be raising from VCs. Now, probably in the initial raises, a few $100,000, maybe even $1 million or so, you're probably actually raising more from angels than you would be raising from VCs, from venture capitalists. Kind of once you get up past raising a few $100,000, then you'll probably be raising from a blend of angels, maybe some micro VCs, maybe some early stage funds. And certainly once you get into the millions, then you're probably, beginning to get into those early stage funds. Yeah, we'll talk about a couple of other topics later. Convertible notes and convertible securities. Now, the point of a convertible security is that it will convert into future equity securities at a negotiated discount in a future round. What does that mean? Because that looks like a whole bunch of gobbledygook as I sort of read it. Well, convert means it'll change into future equity securities. What we're really talking about is that preferred stock, basically, and we'll talk about this a little bit later, but basically the same kind of stock that the new money is going to be getting. That new money would be the preferred or the venture investor in the venture round. Okay. And what this does, and the reason for it, is to avoid valuing the company earlier. Earlier, somebody asked about like, how is it that you value the company at early stage companies? And the answer is like, again, it's a little bit more art than science, looking at comps, maybe trying to do some sort of market analysis. And I'm not a valuation expert. Okay. So there are other people and there are other places you can go on the internet where you can kind of do a deep dive and get a lot more out of it probably than me talking about it. But, yes, as a founder, or an executive at an early stage company, the risk of valuing the company too low is that you will be selling more of the company than you would want to at an early stage. The inverse of that, or the mirror image of that, is if you're an investor, you don't want to pay too much for it. Another true advantage of doing a convertible security round is that it is far less expensive than a venture round, like a Series Seed or a Series A round. There's less to negotiate, there's less to document, and many times, many times, there is like far less diligence that is sort of put in these rounds. They can be done quicker, cheaper. I wouldn't say better from the perspective that, at some point, when enough money gets involved, everybody wants to have sufficiently sort of built out control rights and downside protection, et cetera. But, for where the company is, you don't want to spend a lot of time on sort of legal and diligence and other things at that point. It's not a good use of the fund. Better be putting in the team, better be going for the product. And again, thinking about the model, high risk, high reward, trying to mitigate that risk by investing in many portfolio companies as opposed to just one. So what terms are in these convertible securities? Well, I'm going to highlight sort of the kind of more important ones, and the ones with asterisks are the ones that are found in convertible notes, but not safes. So a maturity date and an interest rate. When you think about a convertible note, like you can think about a loan, basically, that then converts into shares of stock, typically preferred stock. So if you think about a loan, right, you think about your car loan, you think about your house loan, as opposed to like revolving credit, like your credit card. You think about those things, there's a maturity date. That is the date when the money is going to be due to be paid back. And there's an interest rate that you're going to pay for it. And then there are conversion terms, which we're going to Actually, I'm going to talk about, I guess, maturity date and a couple of other things in depth a little bit more. So here's a high level list: maturity, interest rate, conversion terms. One of the things that's important to have is making sure you got good amendment terms, right? So those are typically the holders of a majority of interest. That is, you want to be able to get a group of people together to make the decision to amend with the company rather than having to get each individual investor. The reason for that is you could come up with a situation where you don't want an individual investor to be a holdout and keep maybe your next round from going through, or maybe you need to extend the maturity date of all of these notes and loans. And again, you don't necessarily want to have a holdout have to go to each and every single investor. And then sort of for many of the remaining terms, it's not quite as common to negotiate. Now, maturity date, it's generally sort of 18 to 24 months, but they can be longer, they can be shorter. What you really should be doing is trying to think about, how much time until your next rate. So you got to go back to that sort of chart, which I mentioned earlier, or showed at the very beginning. That is the startup financing life cycle, and thinking about kind of, as you're moving through time towards that exit, like when is it that you're going to be raising successive rounds of capital? How much is it that you're going to need to raise? What are those inflection points going to be? And when you're raising, you should be thinking about like, okay, am I raising enough to get to the next inflection point where I'll go out and raise some more, hopefully at a more favorable valuation or on more favorable terms. And I got some cushion. Now, in a market like this, a market like last year or the year before, cushion might be less. Cushion might be 9 months, 12 months. Maybe now cushion is 12 months, 18 months. It just sort of depends. Sorry, I might sneeze in a second, so I apologize if I do. All right. Guess not. Certainly here, if you're in California, there are some other sets of laws. Same thing too with other jurisdictions. You need to make sure you're paying attention to like the California financing law, which again, sort of similar to securities laws. You're going to want to make sure that there's either an exception to the law or an exemption. In terms of the interest rates can be as low as the applied federal rate, the applicable federal rate. And if you don't hit that, and for quite a number of years, that was basically zero. I actually have not looked at it recently, but with interest rates ticking up, I bet it's substantially higher. And if you don't, you're going to have imputed interest on the convertible note. That is, the IRS will take the position like, sure, you may not have had to pay interest, but nobody gets money for free. So we're going to tax you on the value of the interest that you didn't pay. And then you got to double check usury laws, right? So those are laws in the various states and other jurisdictions where you're only allowed to charge so much interest. In California, you can be as high as 10%, but actually, and it's kind of interesting. It's also indexed to a moving index, so you might be able to get higher than that in California in this current environment. But typically we don't actually see them like at 10%. I mean, it's, I would say probably 6% plus or minus a point or two, at least what I typically see. Mandatory conversion terms. So this is really like the heart of what convertible securities are about in sort of seed financings. It's about not necessarily really getting the safe or the convertible note, okay, because the investors are not really trying to make money off of the debt feature of the convertible note. It's really about getting a mechanism in place so that they can come in, have that preferred stock at a discount price in the future. And so it's the conversion terms, which are like kind of the main economic terms in these deals. And typically they involve conversion upon a qualified financing, which many times is, defined as an equity financing or maybe even a preferred stock financing with a minimum size. And the minimum size is so that, those safe or convertible note investors can feel comfortable that you're not going to cut some bogus deal with your Uncle Harry, basically valuing the company at some number that basically kind of like washes them out, right? It's to get the safer convertible note investors comfortable that, the price that gets cut for the preferred stock is a legitimate arm's length transaction, sufficiently big that, the investors would have, these are real investors and they would have negotiated to get a good deal on it. One thing to really note is that, many times, I think we're going to go into this a little bit deeper, right? But these safes or convertible notes have a discount in them, right? So, and we'll talk about we'll run some pro forma numbers on that. These discounts need to be reasonable, because otherwise when they happen, you're going to either wash out who's already on the cap table, that is the founders. And by wash out, I mean, you're going to dilute them significantly. And or like the new money will think that it's just two things. They'll want to get the same deal. And again, you're going to end up sort of washing out the folks who are on the typical investors, or basically what's going to happen is that they're going to have to get renegotiated later. And again, you don't want to have unreasonable terms in there to begin with. Should you find yourself in a position where you've got to renegotiate, you don't want to have to go to each individual investor. You want to be able to get the ones who hold the majority in interest to basically sign off on it. So another reason for why you want to make sure that the amendment term is set up correctly from the get-go. All right, so conversion terms continued. This is either typically done by a conversion price cap. A conversion price cap, sorry, I just want to make sure that I'm not, yeah. So we're going to go into the mechanics and just sort of demonstrate a conversion price cap. But basically, when we're talking about, the new money paying or determining what their, how much they're going to pay for their shares, they sort of figure out what the per share value of the company is. And what they do is they take the pre-money value, divide it by the number of shares that are outstanding, and that's the number. And again, we'll use a real example on this. And what the conversion price cap is it says basically ignore whatever that pre-money value is that the new money is going to come up with. We don't want that number to be higher than X. So if the new money if the new money has determined that the pre-money valuation is greater than X, use X. If it's less than X, go with whatever is less than X. We see this, with the conversion upon a qualified financing. Sometimes we will see it, in a change of control or a sale, okay? Because that's another situation where you're trying to figure out many times like what the per share price is. And we'll also see this conversion price cap come up from time to time. Basically like an optional conversion at maturity, right? So again, in this space, for companies that are going towards venture capital financing, it's not really about making money off of the convertible note or the debt feature of the convertible note. It's about, having a mechanism to basically buy in now for equity, at some point when the value of it can be like determined. And so an optional conversion upon maturity is a situation where, we're bumping up against a maturity date. We don't necessarily want to extend the maturity date, so we've got a mechanism in there to convert it into equity, probably common stock. So I see a few questions have come in. I want to, let me take this slide and then I'll answer those questions. Got it. Structure. Convertible notes are generally in one or two documents. Either it's going to be a purchase agreement and a convertible note, or it will just be like sort of an integrated convertible note purchase agreement. Now, additionally, when you're documenting these, there's probably going to be a board consent. There might also be side letters, and safes are generally in one agreement, in addition to having any additional corporate authorization and or side letters. All right, let me take a couple questions. All right. So I got a question about what safe is best, Y Combinator or Carta, and what's the difference? I can't tell you that I've looked at the Carta safe. I know there are many different places where the Y Combinator safe shows up. Sometimes people pull them and put them up in places. So you need to run a red line to figure out what the difference is. Used to get a lot of questions before, like September, October of 2018. Y Combinator was using what they call their pre-money safe. Last I looked earlier this year, they're using their post-money safe with sort of like an interim version that came out in October of 2018 through maybe January of 2020. Everybody tweaks the safes a little bit. So you got to work with your counsel on that to make sure that they're kind of dialed in. The pre-money safe, I used to think was a little bit more company friendly than the post-money safe. But there was definitely some tweaks that you need to make in that pre-money safe. Still do make some tweaks in the post-money safe. I think kind of what really is the more critical thing is kind of running pro forma cap tables running pro forma cap tables. That is, basically scenarios of what those safes are going to convert into, based on, again, some scenarios, like some hypotheticals, right? Like if the preferred stock financing is going to have a $20 million pre-money valuation, and your, option pool is going to be, 8% available at that time, those types of things. If you're interested in doing that, I've actually put together a new tool. I just sent a link, in which it's in sort of a limited beta test phase, which is very similar content to this. And it's called Venture Capital Training Camp. And we, among other things, do get into the nitty gritty on pro forma cap tables and things like that. So I would encourage you to check it out. And at this time, I'm not charging anything. So, all the more reason to check it out sooner rather than later. There's a question about what is the financing obtained? What if the financing obtained is private equity, not a public offering? Do the SEC requirements apply, including accredited investor requirements? So anytime securities are sold, so we're talking about convertible notes, safes, stock, investment contracts, etc. Here in the U.S., the federal and state securities laws will apply, and you got to comply with them. Many times, if it's with private equity, it's going to be you're going to be targeting exemptions. Not all exemptions do require accredited investors, but by and large, you do want to have accredited investors on your cap table. There's a few reasons for that. There are certain rules that if you have X number of unaccredited investors on your cap table, you can actually trip them up and have to, file and register with the SEC. That's sort of one of them. Another is if you want to do subsequent deals, whether it's an M&A deal or maybe even a different financing deal, or maybe it's a reorg deal, the exemptions that you initially relied on to do that initial financing, you may not be able to get. So what I'm thinking about is Rule 504 under Reg D, doesn't require certain information requirements to go out to unaccredited investors. But Reg D, or the 504, I think is now, used to be million, then it was like 5 million. I think it might be up to $10 million at this point. But the deal you could be doing in the future might involve $20 million. So you couldn't rely on that. And you might end up in a problem where there's not really a good exemption, and then you got to find a workaround. Maybe that's trying to get cash to these people to get them off the cap table. And so it can just be more complicated. So really, you do want to be even if it's not an absolute sort of legal requirement for accredited investors, you really probably do want to have accredited investors. The other reason too is, if you're raising money for people and you've got a startup, it's high risk, high reward. You want your investor base to be able to like take those losses, okay? Because statistically, that's what's bound to happen, and you want to be able to sleep. You want to be able to sleep at night. There we go. So that cleared those questions. So choosing the right path for your company. Again, we're talking about companies that the venture model is the correct model for them. And that's, that is an underlying assumption of today's conversation. Why use convertible securities? All right. We're talking about raising several $100,000 through first few million. Okay. Upsides. This is kind of typically what is done these days. They're less expensive. They're simpler. You get to avoid valuing the company, which is very difficult to do at this early stage, right? There may not be comparables available, and using financial metrics is a lot of guesswork. Incidentally, it also helps maintain a low fair market value for your stock options and restricted stock. So in other words, like if you're going to be, you've avoided valuing the company. So, maybe you're able to take a position that the common stock or the stock option can be either issued or granted at a lower price than if you just sold common stock, let's say, to somebody else at $1 a share. Downsides. Certainly for convertible notes, is that this is debt. It may be required to be repaid in the future. So you got to pay attention to that. Now, additionally, with respect to convertible notes, is that there is, if there's an exit or a liquidation, some other liquidation in the company, debt gets repaid before equity, right? So if there's $1 million, and this is a simple example, I'm just making up off the cuff, if there's $1 million of convertible notes that are outstanding and you sell the company for $900,000, well, all that $900,000 is going to go to the convertible note holder. I'm ignoring there being any other sort of creditors out there, right? But that $900,000 is going to go to the convertible note holders. In the equity, that is, the founders are going to get nothing. Sort of similarly, if you sold the company for 1.1 million, absent some sort of agreement by the convertible note holders, they're getting repaid in full, probably with their interest. I don't know. There might even be, if there's a liquidation preference in there, maybe they actually would get paid in full plus up to 2x or something along those lines. So again, they're gonna, and actually that liquidation preference might accrue to a convertible, to a safe as well. But basically, they're going to be sitting above the common stockholders, the preferred holders. So, not something to take lightly. Unless there are any other questions on that, I'm going to take a quick drink of water. Then I was going to talk about valuation and dilution before moving on to pitfalls and then taking any other Q&A. All right. So dilution is one of the biggest fears that founders have, which I totally understand, right? Your percentage of ownership of the company is going down, going down, going down in successive rounds. The way that, one sort of rationalizes that is, well, theoretically, I'm getting the money I need to make the value of the company increase and go up and up and up. And the increase rate is greater than the decrease in percentage. And so at the end of the day, it's sort of better to have, 40% of a company that is worth $1 billion than to have 100% of the company that is worth $100,000, let's say. So a few concepts in here, some of which we've already talked about. Pre-money valuation. So that's the value of the company immediately prior to the next round of investment coming in. Post-money valuation is the value of the company immediately after the round. So that means, just from like sort of a simple math perspective, the post money is going to be equal to the pre-money plus the money that comes in. And from a general basis, and I say general basis because each of these definitions in here is something that you would think is 100% standard. And the answer is like each one of these things, it appears on a continuum or spectrum. So you always got to like document this and read the fine print. So fully diluted basis is basically all the common stock issued and outstanding, plus any securities that can get converted into common stock. So that would be safes, convertible notes, preferred stock, plus any shares reserved for equity compensation. One thing that's not normally counted, and again, like you can check out this tool that I'm working on at this point, which is, you know, in beta and not charging for it, and kind of go into the depths of this and actually play with spreadsheets on it, or I play with spreadsheets on it. You know, typically not including authorized shares. So these are just shares that are, you know, authorized in the charter, that is the certificate of incorporation. Those aren't usually included in the fully diluted basis. So with those concepts in mind, and trying to take a very simplified example, so we're not actually thinking about the option pool or any other equity out there. If we just sort of build a hypo, which is like a pre-money valuation of $10 million and 10 million shares that are split among 3 founders, you know, and I don't know if those numbers are right for you or your company. So, you know, don't just rip them off the slide and use them. It may or may not be appropriate. Then each founder would have 33% of the company, you know, 3,333,333 divided by the 10 million shares that are outstanding. If the new money, we're trying to figure out what would they pay, or what's the right price to pay for their investment, they would take the value of the company, $10 million, divided by the 10 million shares to get $1 a share. So if they're putting in $3 million, they would get 3 million shares. And then you can see, if you do the math on that, there's now post money is $10 million plus $3 million, or $13 million. You can see that founder A, founder B, founder C each continue to have the same number of shares. Okay, so these are new shares that have been issued by the company, newly issued shares. They're not, the founders are not selling their shares. And so the founders, just by simple math, have 3,333,333 divided by 13 million shares. So we're building on that and now applying and kind of layering in convertible securities. Let's talk about that. Let's just say there had been a convertible security out there with a 25% discount. Let's say it's kind of like a safe-like instrument. The holder of that security would have received 600,000 shadow shares. So I'm ignoring like the circular math in there. If you're kind of interested in learning more about circular math, check out Venture Capital Training Camp, check out pro forma cap tables. But let's just, again, go with the example where the new money is paying $1 a share. You'd see that the $400,000 that the convertible note holder or convertible security holder, they're going to get they're going to pay basically 75 cents a share. So they're going to get 600,000 shares. So that's 1 minus the 25% discount, that 0.25, which gives you 0.75 times the $1 that the new money is paying. That's how you get the 600,000 shares. They're getting shadow series most typically. And this is where, I don't know if you remember sort of 10 or 15 minutes ago, I said, you know, these convertible securities holders are going to get basically the same thing that the new money is getting. Basically. There are a couple tweaks on it. Okay, those kind of just reflect the economics that they actually picked up these securities at a discount. So the liquidation preference is going to get adjusted so that if the company were to get sold or something, they'd only get the $450,000 instead of $600,000, which, liquidation preference for the new money is $1 a share. Liquidation preference for the convertible note holder or convertible security holder is going to be like 75 cents a share. Same thing with respect to dividends and I think another place as well. Now that is just sort of like your typical discount rate. If we're talking about a cap, so you can see if there had been a $450,000 convertible security with a $5 million cap, the convertible note holder or convertible security holder would have actually gotten 900,000 shares, right? So how do you get that? Well, again, we said before, new money is paying pre-money valuation $10 million divided by the number of shares, 10 million. In this case, though, with the cap, you ignore, once basically you tick up past that, once you tick up past the cap, you ignore whatever the new money is paying, you go with the cap. And so you can see it's, price per share that the convertible security holder is going to pay is the $5 million divided by the 10 million shares. And that's how you end up with 900,000 shares. Now, you can put these two concepts together because many times in safes or convertible notes, they will have not only a discount, not only sort of like a discount rate, but also they will have a cap and the investor will get the sort of better deal of. So if you had, a 25% discount, the better deal of a 25% discount or $5 million cap, you would see the $5 million cap is what's going to apply here. And so that piece of information, which I just mentioned, which is like, once you tick up past the convertible, once you tick up past the cap rate, that may not apply in that situation just because of the math on it. Again, go into like much deeper detail in venture capital training camp. Okay, let's move to common pitfalls because we've got about 3 minutes left, and then we'll take any other questions that you have. So non-compliance with securities laws. And sort of a subsection of that is finders. So non-compliance. So what are the pitfalls, at least here in the US, of not complying with securities laws? And if you're outside the US, you got to make sure you check with the local counsel on that. Well, obviously, if you're a fraudster and you're out there sort of duping people, widows and orphans and, and getting, selling them bogus stock, you may end up in jail. But that's not really typically, the situation. I mean, most of the time, founders are really making a go of it. They're being truthful and honest, which you need to be. And so the perils of non-compliance with securities laws is more of an issue of rescission. That is, you got to give the money back. And the issue for startups is if you've already spent the money on product and other things, you can't, there's no money to be giving back. So that's how that will many times sort of sink your company. Subset is finders, right? There are a lot of people out there who will tell you, I'll connect you to money. Just pay me X. Just give me a cut. And by and large, many of those folks are not in compliance with the securities laws. And so you can end up in the same situation where maybe they did connect you to money, but either they're not a registered broker dealer or they don't meet sort of the exemptions that would permit them to do that. They're an illegal finder, and the company may have a right to rescission, or excuse me, the investors may have a right of rescission, that is to get the money back. One other really common thing that I see, especially for first-time entrepreneurs, is I think there are standard terms. Now, we've already kind of talked about this with the concepts of pre-money valuation, post-money valuation, fully diluted basis. So we're hopefully a little bit warmed up to this, but there are no standard terms. There are many times sort of like a continuum. There's kind of what's market, what we typically see, but you got to always read the fine print on all of these things. Another pitfall are side letters. So these are agreements that are outside of the financing instruments for things. Maybe they're information rights. Maybe they're a right to a board seat. Maybe they are pro rata rights, right? The right to be able to participate and buy additional securities in the next round. And you might say, well, that's great. I hope people want to do that. Well, the issue is, like, if your round is fully subscribed, are you going to be able to get people to cut back on their right? Or is there not going to be enough room to make the deal happen without the founders and other folks taking too much dilution? The reason why investors want that is, again, they sprinkle sort of their cash, and make a number of investments in various portfolio companies, and they don't necessarily put all the money that they've got that they could spend or could invest in the first round. They want to see how you do. So they want to be able to, as a way to mitigate their risk, they don't, again, put in all that money. If they see you're doing well, they probably want to put more in. And so, that's another area where the pro rata rights can be a problem as it relates to side letters. Each time you do one of these, they need to get documented. That can really add cost and expense, several $1,000s for each one of these or so. And then you got to track these rights afterwards and make sure you're adhering to them. Otherwise, you're going to end up with a liability potentially. And another thing we see is just failure to obtain proper corporate authorization. Just founders and others not realizing, look, we've got a corporation here. We need to get a board resolution, or we got to go out to the stockholders to get stockholder approval of it. Again, you can end up in situations where there's rights of rescission, or there are disputes among the owners of the company. And, if you're at an early stage company, a lawsuit can absolutely tank your company, or even the threat of a lawsuit can tank your company. So with that in mind, we have come up on time. I hope that you have found this information helpful. Please let me know if you have any questions or comments. I'll take questions or comments for the next few minutes or so. Use the Q&A function if you don't mind. Oh, thank you. I got some good positive feedback. It's always so interesting and a little bit different and difficult to give like these online presentations, because I don't get any live feedback. When I used to do many more in person, it was always great because I could read the room and you can kind of see who's excited, who's engaged. So thank you. Thank you for that feedback. Feel free to also connect with me on LinkedIn. I do keep office hours, typically Fridays at 2 o'clock to about 3 Pacific. And, if you're outside of my time zone, we can probably make a time that fits. Question about sort of replay. Yes, so long as you have registered, we will send you the video afterwards. Again, do check out Venture Capital Training Camp. I'll just put one more plug. It's in a limited beta stage, so it's not perfect, but I'm just kind of releasing it to get some feedback. Hopefully, as entrepreneurs, you can identify with that and appreciate that. All right. Let's see what else. I feel like there's one other thing that would be sort of like a bonus topic that I wanted to mention. Oh, no, that's it. All right. Well, I'm going to wrap it up. Should you have any questions, comments, feel free to reach out via email or connect with me on LinkedIn. Please don't send me like legal questions via LinkedIn. If you want to talk or have a general information session, just send me a note, jason.gordon@klgatescott.com. I wonder if I've got this. Oh yeah, here it is. It's at the bottom of each slide. I should put that at the bottom of the bottom slides. All right. Thanks a lot. Have a great day. Take care. Bye-bye.